Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. With me is Tamanna Inamdar, and we are going to be doing a 22-minute conversation with two experts on what they feel is the current state of the markets, with the cries around valuation being now there for a while, and a few recent developments, notably the Hindenburg note as well. So all of that forms a part of our first set of questions to Nandik Mallik. He's CIO of Avendus Capital Alternate Strategies. Nandik, so good having you. Thanks for taking the time out.
Thank you so much, Neeraj.
So, have you been concerned about market valuations in the recent past, and did Q1 did enough to kind of, if not allay those concerns, if you had them in the first place, but to at least live up to its billing?
No, I'm not so much concerned. I think our markets have been behaving very well. In fact, if you look at how the markets have behaved, we have become low beta. So previously what used to happen was global would be down 5%, we would be down 7%, global up 2%, we are up 4%. Now what's happened is global is down 10%, we are down 3 or 4%. On the way up also global is up 5%, we are up, let's say, 2 or 3%. So that's why I don't think, let's say even if valuations are high, I don't think that's a cause of concern, because markets in general have become low beta. And people who have made wealth in the last 2 or 3 years have actually made wealth by holding on to the portfolio for long. So in that case, I think the high valuation concern is a lesser issue as of now. Things like, people putting money consistently in SIPs and funds, I think those things are more important. And one important factor which people have ignored is how rupee has behaved. So in the last week, you talked about the carry trade, JPY moving from 160 to 140, going back again. I don't remember when rupee has moved from 83 to 85 band. I don't remember last time it happened. So rupee has been fairly stable, which shows that possibly from a macro perspective, we are fine. Markets, earnings will keep coming, going, but we are a growing economy. We are still not exactly developed markets, but I think we are not in that EM phase as well.
EM phase as well, yeah. But are we looking, I mean, let's assume that last week was a turbulent one because of the whole JPY thing, so on and so forth. Are we looking at calmer seas ahead, because we are 1 week closer to a Fed event? JPY will not now react as much as they did because of the BOJ government doing what they've done. And the fears of that hard landing in the US seems to have ebbed a little bit. So are we looking at calmer times ahead?
Yes, I would think so. More so because Fed has indicated that the rate cut is around the corner. Now, from this stance, I don't see at least a rate hike happening. So the only two possible scenarios are either status quo with a lower probability, or possibly a 25 or a 50 basis points cut. I don't think we should be concerned, because RBI, in my view, is in no hurry to follow Fed. I think RBI for the time being would be more concerned on the gap between what our rates are, and historically they have been much higher. So whatever little talk people do about RBI following the Fed, I think it's a long way down the line. RBI would be very happy to let the rate gap increase. Even then, they would be much lower than what the historical numbers are. And I would want to say RBI has done a wonderful job at controlling, or let's say, seeing how rupee has been panning out.
Yeah, in fact, after the last policy, most assessments have seen the first rate cut move from Feb to October. But the RBI governor was very clear that food inflation is bothering him. So he's in no rush. Nandik, I have to talk to you about the big topic this weekend, and we've been seeing how markets have reacted. I think when that first set of tweets came out, big thing coming India, sort of from Hindenburg, everyone was wondering, oh no, what's going to happen now? What happens to our investments? What happens to markets? Fair to say that markets have ignored something which showed no credibility.
So markets haven't ignored it 100%. The next time this happens, market will ignore it 100%. So the last time this happened, if you remember, the reaction was much more steeper on the way down. This time the reaction has been a bit more mild. So markets haven't completely discounted it. Markets have reacted to it. But the more this happens and the more consistently they keeps happening on a regular basis, then at a point of time market will not even talk about it. So for example, the media channels are now discussing about it first thing in the morning. 2 or 3 more sessions like this, and people will not talk about this only. You may remember after the exit polls and after the elections, there was talk about how exit polls were rigged and short sellers made money. But even from those levels, Nifty is higher now. So the more these kind of things happen, I think it's good for markets, because our market participation is fairly deep, and this tends to show that everything is in order. So, the more these kind of things come, it's actually good for the long-term stability.
No,
of market.
but in that, having said that, let's look specifically at what the allegations are, what the responses have been, because for us to just shrug off and say, okay, markets are deep, that's fine. But this time round, especially, Hindenburg seemed like they were grasping at something or the other.
I think we should have an interview in which we should interview you, because you have put the points perfectly. So I would not want to say it in black and white so much, but it's evident as to what's happening, and that is the reason possibly why even equity markets haven't reacted so badly. And the research which they have done seems to be fairly on the poorer side. The kind of arguments which they have given, the kind of data points which they have pointed out. So again, it's a good thing that these things are coming, because this just shows how fair and how resilient the markets are.
Yeah. So what happens next, Nandik? What's your sense? Let's assume there is an event like this which has brought the market down a little. Maybe it brings the market down low along with what's happening to global markets. Who knows, right? But let's assume for whatever reason the markets were to correct a little bit, 1-2% or what have you. Because we are closer to that event, and because you're saying that this is worse per se a non-event, are you a buyer? I mean, were you sitting on a bit of cash around elections? Have you deployed all of that already, or are you in the process of deploying it? Are you a buyer currently? What are you doing?
See, if you look at the data on the 3rd or 4th of June, when there was a sharp crash, and then there was a bounce after that, I was surprised that most of the buying was done by the retail / that segment. So it seems there are people with a good amount of cash ready with them, and it looks as if status quo, if nothing happens on the global front, then at least major dip would be bought into.
No, let me try and ask you, reverse this. Sorry, just one follow-up there is this, that we are closer to the Fed rate cut. Typically a Fed rate cut, and since COVID lows, the Fed has moved the market more than anything else.
Right.
We are closer to the Fed event. If you will, we'll probably, I mean, good hypothesis that September we'll see a rate cut. Domestic mutual funds are sitting on over 1 lakh crores of cash.
Yes.
So is it prudent to think that there is a higher probability of an upside on the markets over the next 3 months versus a downside?
Yes, I would tend to agree with that assessment.
Okay.
More so if nothing happens on the global front, because people are focusing on the Fed part, but I think a more important event is the US elections.
Okay.
And the front runner at this stage has been a president in the past, and typically that gentleman has been more market friendly. So together, the Fed event together with the probability of that event panning out, I think the chance of an up move is higher. Valuations are high, you are correct, but then I would still assign the chance of an up move to be higher.
So let me reverse that question. If Kamala wins and Trump doesn't, would that be seen as a negative for Indian markets?
At this point of time, I think it would be bad for global markets, at least US markets is what my assessment is. But again, we are low beta. So very surprisingly, we have become low beta. We definitely should not fall as much as what US does.
Okay, yes. I take that point of being low beta. One thing that we are quite sensitive and reactive to, specifically on individual companies and stocks, are earnings. And typically in a market like this, earnings take center stage. We're pretty much done with Q1. What has been your assessment?
Not very great, to be very honest. But I think earnings in the present setup would be secondary, because if rates start coming off, that funding pressure would ease. So a lot of, even if let's say the earnings are going off by a few basis points here and there, would be more than compensated from the funding pressure, the release which corporates would get.
In terms of what has, the good, bad and ugly, overall you're saying they haven't been that great. What has been the standout in terms of this was a miss? Can I pick up financials? Because the commentary has been consistently that deposit growth is a problem. There seems to be no change on the horizon which would, clear up that picture.
See, my view is, and I've shared it multiple times, is that, there are some tax arbitrages between various options available to investors. So my favorite example is arbitrage funds, which get classified as equity taxation, but for all purpose they are debt funds, but they get taxed at very low rates. So till the time you have these kind of imbalances, the dice would be loaded a bit against the deposit sides. But I think deposits are a cause of concern in banks, but again it's easier to address. For example, addressing these imbalances are fairly on, but they have to come from the authorities. So it's not something which is in the hands of the banks, but yes.
On low net interest margins, raise your deposit rates.
Yeah, but then raising deposit rates also has other implications, no? Yeah.
No, but so then to answer the question from an investing perspective, are banks a good shoe-in or no? You like
banks,
other places?
No, banks. I'm a bit more positive on is because they have underperformed so much in the recent past.
Okay.
And it's not that banks are lightweight in the Nifty index. 35-40%, if anywhere between 35 to 40% of the weight is banks, and the index has to move. See, I think most of the people who invest in banks are long-term investors. They typically don't like to invest in banks for 3 or 4 months, books some profit.
Or foreign investors
Correct,
who have been MIA for a large part of this year.
Yes. So, and then there is talk about relaxing the cap on foreign holdings as well. So, these things happen, then you never know, because the regulators won't, announce in advance that something like this is around the corner. So because I think it's a good time for sector rotations, and sectors which have done bad, let's say in recent past, status quo should do well. So banks fall in that category.
Just on that question of foreign investors coming in or global money coming in, do you see that changing post the 2 events we've been talking about, the rate cut expected in September and then the US elections?
I think we are past that stage where now foreign investors decide which side Nifty is going. I think it's turned a complete circle where domestic investors, domestic fund flow, domestic sentiment primarily drives. Foreign sentiment is important, but then it's not what it used to be 10-15 years back. So I think the local sentiment is strong, and what seems to be a recurring theme is buy on dips. What can interestingly happen is in many of these passive funds, and now they are growing in size. So what they do is they allocate to different geographies and countries, and typically they have a fixed formula. It can be by GDP, it can be by population, whatever. In each and every factor, I see India's weight increasing only. So, we may come to a stage where, irrespective of valuations, because of the demographic advantage or let's say other advantages which India has, that allocation will only keep on increasing.